last week I was doing a presentation to a rather large group of company directors, and I was talking about my view that the increase in the US budget deficit would drive down the US dollar, and that would generate increase in oil prices. But I also thought that it would generate, that falling US dollar would generate a better environment for emerging economies. And one of the directors asked the question, well, wouldn't it work the other way around? Surely if the currencies fell relative to the US dollar, they'd be better off. And I said, there's a whole bunch of research by the Bank of International Settlements which says it works the other way around. But today I thought I might talk a little bit about how we got to the point as a result of a couple of heroic catastrophes in the 1990s, of how we got to the point that emerging economies are financed the way they are now, and how this generates this situation in emerging economies, and they have the ability to provide more funding for international trade. And so when you have this situation of the US dollar going down, you tend to have these booms in emerging economies, and which is what I think is going to happen over the next 2 years. So the original catastrophes in the 1990s were caused by experiments on how to lend money to emerging economies, and these came after, these were started off in the current form in the early part of the 1990s. Back in 1989, for those people who remember that such a year ever existed, the US budget deficit was 2.8% of GDP, but the Fed funds rate was 9.75%, which in the current world would crush the economy and generated a recession. And that's exactly what happened then. You had a housing crisis in the US over the next 2 years, and you had a major recession in Australia, the one that Paul Keating called the recession we had to have. But as a result of what then happened in the US, which was a really catastrophic housing collapse and the collapse of housings and loans, two things happened. Firstly, the budget deficit blew out to 4.7% in 1992, and the Fed cut the rates by 6.75% all the way down to 3%. And that generated a boom in finance in US dollar assets, and particularly an international boom in finance and international assets. And who should start getting these large US dollar loans were not just corporations in emerging economies, but governments of emerging economies. And they got a vast amount of US dollar debt in sovereign debt, okay, to these countries, particularly the countries to the north of us, Indonesia, Thailand, South Korea in particular, the Philippines and places like Vietnam were just really emerging at that time. And what then, of course, occurred over the following 5-year period is that the US budget deficit, which was encouraging all this, became balanced. You know, a horrific thing to happen. And so you moved from a budget deficit of 4.75% in 1992 to a balanced budget with a surplus of 0.3% in 97, and the Fed funds rate went up by 2.5%. Well, what that caused was the first major sovereign debt crisis in US dollar debt, and that's what became known as the Asian debt crisis. And Thailand collapsed first. There was then, and after that, but their sovereign debt collapsed first. And as their sovereign debt collapsed, that generated a collapse in their private debt. So you had a sovereign debt collapse, which was followed by a major domestic slump, and that process was repeated incredibly rapidly in places like South Korea, the Philippines, Indonesia, and it was thought to was widely forecast, and in fact Japan actually, was widely forecast to bring the Australian economy down, but didn't. But that's a separate story as to why. Now, this was followed the following year by a perhaps even more heroic crisis in Russia, and this was because the budget deficit had actually, a budget surplus had actually increased a little bit further to 80 basis points. And with the Russian debt collapse, you had the collapse of oil prices, and oil fell to $12 a barrel. So hence the connection between emerging crises and oil crisis. Now, rather intelligently, what happened was over the next was that the Fed started to cut rates and provide easy money, and that stimulated the circumstance. But what had happened here was a really horrific lesson for emerging economies. And a lot of emerging economies, when you actually spoke to people who were at the leadership or running the finances of them, as I got to later in various international environments, is they felt shame and that this had happened to their economies. And so they yielded to a whole lot of advice, which was good advice, unusually, from people like the IMF and the Bank of International Settlements, that they should move their debt towards own currency sovereign debt. So the Thais should finance their sovereign debt in Thai debt, the South Koreans in their own currency, the Filipinos in their currency, the Indonesians in their currency. So, but what this generated, this solution, what it generated was a circumstance where all of their sovereign debt was financed by finance in their own currency terms, and there are all these banking services provided, particularly by US banks, to provide the service and provide these debt issues and provide hedging and currency hedging in their own currencies as a result of this. But it left the circumstance where all their business debt was still financed in US dollar terms. And that was the solution to those great crises of the 1990s. And that's the situation that continues still. So overwhelmingly, the Thai sovereign debt is now financed in Thai baht, but businesses in Thailand are overwhelmingly financed in US dollars. And you'll find this as you go around the Western Pacific, and you'll find this if you go through Latin America and other emerging economies. So what that then generates is a circumstance where the way the sovereign debt operates is really very, very different than the way business debt operates. And the way business debt operates is the same way that commodity finance operates. So that if, for example, the US dollar falls in the current circumstance, and you've got a corporation which is a manufacturing corporation in Thailand or in Vietnam and it's borrowed in US dollars, the amount of debt that it has to repay when the US dollar goes down is less than the debt it started with. And so what you find in periods of falling US dollar, you get very, very low effective debt rates, and you get enormous increases in liquidity in emerging economies to finance their domestic manufacturing and their international trade. And the Bank of International Settlements and others have found that as a result of this falling liability in US dollars for manufacturing firms in emerging economies, what you tend to get is this boom in manufacturing and boom in manufacturing trade, and therefore an increase in demand for imports from those countries. So that's what I anticipate will occur in emerging economies over the next 2 years. Yes, I expect there will be a boom in commodity prices because of the boom in US dollars, but because of the fall in the US dollar, but that fall in the US dollar also reduces the liability of manufacturing firms as emerging economies and generates a boom in manufacturing in those economies as well. Just before I leave, and I might talk about this more next week, my current Brent model for oil suggests that the Brent price should be trading now, after a little bit of decline in the US dollar already had, should be trading $12 higher than it currently is. And my West Texas price should be, with the little bit of decline the US dollar already had, should be trading $10 higher than it currently is. So that movement in upward oil prices, as well as recovery in emerging economies is already beginning.